Hello, 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 Montreal. So listen, I feel in coming to Montreal, there's a big elephant in the room. So as your cousin from the South, I'm just going to say it. What were you guys thinking when you traded PK Subban? What happened? Come on. All right, so I'm going to talk about disruption, just letting you know how we're setting up. We have two speakers. At the end, what we're going to do is we're going to have a little Q&A, so we'll come back both up together. But disruption is one of those topics that everybody loves. What I'm trying to do with this is really give you a little historical perspective in finance. And I like to tell stories, and I like to use pictures. So hopefully you won't be bored. We'll have some interesting pictures, and we'll go through. Are you ready? All right. Boom. Let's take a little time period here of World War II. And I want to kind of focus your attention on this. Of course, that's the atomic bomb. And when I think about that, there's a lot of things that had to go into, and I think there was a speaker earlier this morning who talked about World War II and the changes. And really, in order to build an atomic bomb, there are things that had to happen beforehand. And this is really a point I always make about disruption, is yes, we see the event, but there are so many things over time that have gone into it that actually manifest. For example, you can't have an atomic bomb without higher order math, computers, and modeling. And I want you to remember that. So this is like 1945, right? Yet there was a lot of work that went on beforehand to get to that point. So keep this in mind. In order to get there, you've got computers, you've got modeling, you've got math. That's necessary, and yet that change took a while. Let me set you the stage for finance. For most of finance's history, it's not really a technology place. And in fact, it's mostly people like this, JP Morgan, right? It's a confined group of people who do something, who basically move markets or companies, but it's not really for everybody. And I would say up until about the 1950s, that's really the image most people have of finance, which is it's the robber barons, it's basically the really wealthy people. That's what finance is. And oh yes, every once in a while, the smaller public gets involved, but it's not widespread. What changes is, once again, back to this World War II piece, is after the war, you've had this tremendous amount of industry that's built up. And then returning GIs come home from all over, and really it's in North America, which is untouched by the war, that this massive build-out of companies and industry goes on to serve the rest of the industry. So typically you have here, this is great, right? Returning GI starts a family, is the accumulation of wealth. And people are starting to actually make excess money. And when you're making excess money, you start to think about, what do I do with that money? Well, I could buy a car or a house, but maybe there's something else I can do. And you're getting companies now that are actually producing much of the goods for the world here in North America and the United States. So think of this context. You've got all these people now, families, excess wealth, taking care of themselves. What's the natural thing that happens next? Advertising. Advertising hit finance. And in a big way in the 50s, we started to get to this point of where advertisers would tell you, I think you should probably do something with that money. In fact, there's a whole industry that sets up in itself in a place called Wall Street, which you've known, where people start buying stocks. And it's not the JP Morgans who are buying stocks, it's the regular people. In fact, here's an example. What should you give your kids for Christmas? Merrill Lynch says give them stocks, right? This is the context of what happens, is you've got now organizations en masse telling people to buy securities, which means there are now companies or brokerages that are out there that are taking money and they're buying what? They're buying stocks, and they're buying the biggest, bestest companies out there, right? The General Electrics, the Boeings, the other things like that. They're buying these bigger stocks and they're pouring money into the stock market, right? Now, back to this, I told you that finance, at least, everybody thinks is a high technology place. That's not exactly true at this era. In fact, this might be the height of technology. That's the 60s. That's a blackboard and a bottle of champagne. That's technology in the 60s. If you've watched Mad Men, guess what? It was the same on Wall Street. Somebody would actually get quotes from a machine and write it on the board, and people would look at it. doesn't exactly sound too high-tech. Well, there are elements of high-tech, right? There's counting machines with punch cards, but that's really to kind of enumerate market prices. So what's going on, right? It's like 1950, 1960. What is really the key technology of Wall Street? Paper. Now, this may sound quaint, right? But think about this for a second. You've got all these people now thinking in a wider sphere. A generation is investing money in stocks, right? And they're actually investing in a physical piece of paper. And I want you to think about this for 1 second, because we have a very different concept about money and value today. Money is virtual. Well, money is not virtual here. Money is actual paper. And when you buy a share of stock, you're actually buying paper. That paper has to go from one place to another. And here's how I remember that. Anybody remember the movie Die Hard? Show of hands. Okay, good. I'm working with the right audience, right? So the so-called terrorists were actually thieves. And what did they want to steal? They wanted to break into the vault at the Nakatomi building, right? And they wanted to steal negotiable paper. That's what this was. This is paper that basically nobody really knew who owned at the time, because it had to physically go somewhere. And what that means, in a sense, is that when you traded stocks, there was a group of people on Wall Street who actually took that paper from one place to another or mailed it to actually somebody to prove ownership. It was not virtual. So think about that for a second. As the market is climbing and more people are coming into this, and people, and I'm talking about advertising and sales, they're actually going out and building the business. The market in the 1960s went on this fantastic upswing. It was incredible. And in fact, there was an event that really crystallized changing the market, was in 1968. Lyndon Johnson, who was the president at the time, and actually the president while the Vietnam War was going over, actually announced he would not run for re-election. Now, you would think that might be a negative for the market. It wasn't. It was actually a positive for the market. As most things in Wall Street go, when you think it's going to be good, it's bad. When you think it's going to be bad, it's good. Anyway, Lyndon Johnson announces that he's not going to basically run for re-election, which was accepted as a huge positive fact. 1968 was one of those banner years on Wall Street when basically the market went vertical, which meant every broker made a ton of money. But there was a little side problem to that, because I just explained to you everything is paper. And the problem is this: they couldn't catch up with the demand of shifting paper around to the proper owner. And in fact, as the market spiraled all the way up to a total market value of $400 billion, which is a lot of money back in 1968, there was a little sideline problem, which we call failures. And they're failures to deliver. And that means these brokerage houses started to fail in delivering paper. Right? So in that peak watermark over there, there was roughly $4 billion worth of value of paper that nobody knew who owned. Now, that may not sound like a lot, but the brokerages, there was about 400 brokerages at that time who were members of the NYSE, is they didn't have enough capital to cover that. So these brokerages only have maybe tens of millions of dollars in excess capital to cover, so you got a problem. So if you remember what happened in 2008, there was a problem around having enough capital and capital in the bank. Well, now you've got this obligation out there of $4 billion for the market as a whole, and you don't have enough capital. So this is what a back office looks like. Imagine this. These guys are working as hard as they can to shuffle the paper and find the paper and move it around. In fact, it got so bad that Wall Street actually closed on Wednesdays just to handle the paper. They would close one day a week just to handle the paper. Now, you would think this is the punchline, right? It's like, hey, Rob, isn't this the part where computers come in and really make a difference? Sure, they started to come in. But what happens in these kind of disruptions, and everybody thinks to solve, is a silver bullet. There's some silver bullet out there. So brokerages started to go out and spend larger and larger parts of their budget on computers, on mainframes. Firms like IBM or Control Data or even Ross Perot's EDS. And they started to spend this money, and they started to find out is that the utility for what they spent on was very low. Is that, yes, they could do some internal ideas about managing paper, but the truth was they still had to deliver the paper. And that was the backlog. So if you remember what I told you, there was roughly 400 firms, member firms that are out there, are part of the NYSE. There became a wave of consolidations as another event happened. In 1970-71, is this tremendous volume that was built out fell. And in fact, the market dropped, is what is known as the 70 classic bear market, to a level that was about maybe 20 to 25 or 30% lower, which meant all that wonderful business that was coming in was not coming in anymore. So imagine, you spent all this money as a brokerage firm, right, on future profits that have not come. You've got a deficit. You've bought these computers that really are not doing anything for you. So the necessary thing that happens is this. You go broke. And in fact, about 120 brokerages collapsed or were acquired. Names you wouldn't even know anymore unless you looked them in the history books. There was a firm by the name of Goodbody. Well, now they were Deadbody. They weren't around anymore. They got pretty much acquired by Merrill Lynch. There was another firm called DuPont. And the key that happened here is that you had such a consolidation, it changed the nature of the market. So today I want you to think about this. Paper actually was phased away in 1973, 1974, when we did something called depository trust. We actually changed the nature of the market because we did a thing called book entry. And book entry at that point allowed, for the most part, is stocks to be virtual. And the minute you did that, that allows a different change. The minute that you can make the actual physical paper disappear and become a number in a ledger that can be transferred at computers, you have things like this. And if nobody knows what that is, let me just tell you exactly what that is. That today is the stock exchange. I know it doesn't look like that cool little Gothic building with the columns. That is a brick data center in Mahwah, New Jersey, not on Wall Street, and that's where all the transactions place. And the only reason that can happen is because we shifted from the paper, in a sense, and became virtual. So what does it say about disruption? I'll run through and then we'll get Sue up. The first thing you need to know is that sometimes disruptions are quietly hiding. They're building in a time. And maybe we don't see them, but they're there. They usually take a catalyst event. Like the atomic bomb, it focuses everybody's attention on. Like in Wall Street, the paper crisis. That catalyst event makes you focus on what's happening, and all of a sudden you're like, whoa, something's different, right? Adoption. Adoption takes time. It took about 25 to 30 years for really this system to take adoption on Wall Street, the changeover from basically paper to virtual. But it happens, which means there's opportunities. It isn't gone away from you. It's coming to you. It's there. Incumbents do see something. In fact, they made investments. But they didn't understand the characteristic of the investment they made, right? So they respond, but it wasn't really the right way. And then this critical mass that you see creates a norm. And you start to see the market change because a mass becomes around that, and it happens. That's really what happened later in the 80s when trading became more virtual as well and took advantage of algorithms. And lastly, it creates and destroys value. So for every firm that went under in the 70s, there was another firm that actually took and came forward. In fact, all the things that happen in the market today that you see, where firms like Schwab or TD or others really built a business, happened because of the seeds of what went before. So that's what I'd like to say to you about disruption. I hope I gave you a little story. And then now we're going to have Sue come out, and she'll talk about it, and then I'll join you later. Thank you.
Okay. Hey, good job. Hi, everybody. Ooh, that feels loud. I'm Sue. I am CEO of FGS. And I'm going to actually talk to you about the future of finance. And I'm going to tell you a little bit about myself. I got a really nice introduction. But I want to tell you a little bit about how my future in finance, which I spent 25 years of my career in technology companies selling to financial institutions. But it actually started with my first job at the Four Seasons. And I worked at the Yorkville property in Toronto, and it was long enough ago that Isidore Sharp still, came into the hotel, and he actually joined one of our training sessions, and he taught us about the Golden Rule, which I'm sure many of you know, but it really had an impact on me, mostly because when you're working at the Four Seasons and a guest asks you for something that's not in their room or not on the menu, the golden rule is treat people the way you want to be treated, but it really at Four Seasons is go and do whatever it takes. So, so I got this DNA imprinted on me to listen to the customer. And then I went on to work for tech companies, and I was probably the worst employee because I kept listening to the customer and not selling or creating what the company wanted me to sell. And so that's how I got into this space. Alistair. I have to take out my earring. Okay, don't wear jewelry when you're presenting. Alrighty, so does anyone know what this picture is? Does anybody recognize it? If you do, say so. No? Has anyone heard of Black Mirror? Show of hands? A few? Oh, okay, good. I should have said that. Put up your hand. So this is from Black Mirror, which many of you know, and it's a satirical or dark view of how technology may change us as people, change society, and so on. I actually watched the show, and I don't feel like it's that scary. I think that some of those things are really interesting and cool, and likely are all going to come true at some point. But I think what this image doesn't say, or what it actually does say, is the future is bright. And our talk is about the future of finance, and about how we're really only getting started in terms of the disruption in the financial services space. So just to level set, because Rob talked about the past, I'm going to talk about the present and the future, and then Rob's going to come back up. I'm going to talk about where we are today. So there's a lot of innovation happening in financial services, but in Canada, we're relatively slow to get to market with innovation in financial services. We have a few very big banks. They each have lots and lots of employees, and so their products, which are heavily regulated, their delivery mechanisms, so how we buy them, are also heavily regulated. But there's some innovation. Everybody can use their mobile phones to pay a bill. You can buy insurance online. You can do a claim online. So there's some progress, but generally speaking, in Canada, as compared to the rest of the world, we are somewhat slow to really transform finance. And then along comes FinTech. So I worked for one of the biggest FinTech companies in the world, although they became that after I left, and they were recently bought, and they're now called Finastra. And they had 9,000 banks as customers, and they were a FinTech company, a big one. But what's happened over the last couple of years is that new entrants are coming to market with new products, leveraging new technology, and now we're seeing this explosion of startups trying to get into this space. And you might ask yourself, what's really driving it? Well, there's lots of things driving it, but there's 4 big things. One is technology. So, using your phone to conduct your financial transactions. And, lots of other things, artificial intelligence, machine learning, blockchain, all sorts of different technology innovations that are now things that, are present in our world and starting to take hold. The customer. So this is a picture of a young person on a mobile, or sorry, on a computer, and different demographics, different customer segments, like millennials, have different expectations. They want things really fast. They want the best customer experience. And that's probably true of everybody, because I'm certainly not a millennial, and that's what I want too. But consumers have really kind of jacked up their expectations for their financial services experience. And then we've also got investors driving a lot of change. So investors like Sequoia and others who are investing a ton in FinTech startups, which is driving it. And then strangely enough, and you can debate me, but I think regulatory or regulators are also driving change. So in the UK, the Financial Conduct Authority, the FCA, actually has mandated competition, mandated that new companies come to market and to compete with the big guys so that consumers get the best choice. We in Canada don't have that same structure, but it's coming. And so one of the big things about, you know, how quickly is FinTech going to take hold? Are these new offerings going to take hold? Is just your typical adoption curve of new technology. This is Everett Rogers' view. I think it's going back to 1968 or something like that. But to say, you know, your adoption curve really starts with your innovators, who are the ones that are willing to try anything, your early adopters, who are kind of that next stage. And then it takes a while, but you'll get into your early majority, late majority. And what's interesting is when we look at other regions, and this is an Ernst & Young report, there are other regions that have actually surpassed that early majority, are now in the late majority. So China and India are now well above, if not double, the global average for consumer adoption of FinTech solutions. So, and Canada has grown really well. So from 8 to 18% over the last 2 years, but we're still well above, or well below the global average. But we're getting there. So clearly FinTech is not a bubble, it's not a fad, it's actually going to take hold. And so I'm going to give you some examples of FinTech companies to give you some perspective on what that means and what the future could look like. But first I want to kind of put them into two categories. So we see a ton of FinTech companies. I reviewed 91 FinTech companies for Sibos, which is a big event coming to Toronto in October, where you'll have 10,000 people and probably every global bank coming to see the best of the best FinTech startups in Canada. 91 applications. So there's lots of them. And for me, if I put them into two categories, it helps me kind of get that straight. So one category is, you know, those on my right, this right, that are technology-based. So that's supposed to be a picture of a complicated, you know, infrastructure of a bank. You probably can't see it, but it's supposed to represent all these channels, right? I've got to provide solutions to people that want to go into my branch, who want to deal with me on the phone, who want to use services online. And then I've also got all these complicated systems, of which most of them are in our big banks in Canada and big insurance companies, 40 years old. And so there's FinTech companies that are coming to market, lots of them, probably more than what you know because you don't see them. They don't get front page news because they're making a process more efficient or they're reducing costs. But there's lots of them that are helping solve the problem of making banks and insurance companies better. On the other side, you've got business model innovators. And that is a really interesting category of fintechs because they're the ones that are saying, hey, you know what, why won't you give me a loan, you know, because of my credit score, but I have all this other stuff that you could use to validate that I'm not as much of a risk. And so, you know, up are popping companies that are able to provide services that the banks won't provide. And, you know, it's kind of like Uber. And my first experience with an Uber was when I was on a business trip in Boston. I was with a couple of colleagues. We left the bar. I was going back to my hotel. The guy I was with, Matt, he said, OK, let's go. And so I thought we were going out to hail a cab. This was probably like 4 years ago. And this black car is sitting there. And then he opens the door, doesn't even like, I'm like, OK. And he opens the door, and the driver says, hey, Matt. So I was like, hey, what is this? And it was just that kind of experience that was seamless. It was, you know, you get in the Uber, it drops you off, you don't have to, you know, come up with cash because the taxi driver doesn't want your credit card. It's just a great experience, right? That's about changing a business model. It's about changing the way we actually consume, not just consume, but what we actually consume. So I'm going to give you some examples of fintech startups that are, and there's many, many more, and I met a bunch of great companies here. But I chose these 3 to talk about that are really trying to help on the technology side. FinAI is an artificial intelligence chatbot solution. They announced that they partnered with ATB, I think last year, and that just allows us as customers to choose the channel of chat to do banking. So I can use my Facebook Messenger or my text, and I can say, what's my bank balance, or pay my bill, or whatever. Sensible, I can take pictures of my receipts, and then I have no trouble finding them when I need them. Veride, a company that's not on anyone's radar because nobody's invested in them, but has been doing business with big insurance companies for a long time, talking about how to make financial advisors more effective when dealing with their customers and helping them be more digital. So this one, I'm going to actually just take 2 things about this, and I'm going to show you a quick video. This one is actually about Lemonade. It's a US-based company. I picked it actually because it's got the shortest video, but it's cool, and it's business model innovation for insurance. Can you play the video?
You have a lot of stuff, and you love the things you own. You never want anything bad to happen to them. That's why you get insurance. But old insurance kinda sucks. You pay every month, then when you need help, they give you the runaround. It's because they make money when they say no. That's wrong. Lemonade is different. When you pay, we take a small flat fee. The rest goes to covering your stuff. So if something happens, we pay super fast. And since we don't have brokers, we're super cheap. All this is available from the comfort of your smartphone. But here's the best part. Most years, we'll have money left over. We take that cash and we give back to causes that matter to you. This is what insurance was always meant to be. Protecting people and strengthening communities. That's what we're all about. That's Lemonade.
Awesome. That's just an example of a new business model for insurance. They make money based on a transaction fee. The founder, I watched a video of him at another startup event, and he talked about the fact that they're not in conflict with the customer. They're not actually trying to not pay your claim because they've already made their money when you bought their service. And they also donate the rest of your unused premiums. When your policy ends, they donate it to your charity of choice. So it's pretty cool. We have a lot of other startups like Slice and Trove and others in insurance that are doing similar things. I wanted to show you League, which is a Canadian company, doing another great thing for the health benefit space in a new business model for health benefits, which also is charging for their technology usage versus the premiums. And then we've got banking, which is we're starting to see a little less happening in Canada, but some things on the horizon with Stack and with Planswell and other companies that are all in sort of their waiting list beta mode, where we will start to be able to have different alternatives to our bank account, where we put our money, and how we plan for our future. Moven in the UK is fairly well talked about in the media, and it's been around for a couple of years. It is definitely challenging the European banks. And so what does this all mean? What I was hoping to try and convey to you guys is, this big financial services market where there's over 20,000 banks in the world that have been there for a long time, do great work. With all those forces coming at them, they need to innovate, they need to change. And some of those startups are going to help them, and some of those startups are going to actually disrupt them. And I'm going to ask Rob to come up and share the last slide with me, and he can do, there you go. I wanted to talk first, though, and you can join me on this one, Rob,
okay, good.
about these guys. These guys are, most people are talking about them as potentially really disruptive in financial services. Well, they already are. So Amazon, for instance, is one of the biggest lenders now. They lend money. They don't just let you buy services. WeChat or WePay and Alipay are in their markets in China and whatever. They're doing a ton of financial services business with consumers. So I think we're going to see some of these guys take a bigger piece of the market.
They definitely are in the right playground, because if you think about all of them, like when I look at these slides, especially from Amazon and Apple, if you realize this, those two companies alone probably have more credit cards on file and a unique ID that's tied to a credit card than anybody. Which means from a payments point of view is they could basically disrupt the entire payments market anytime they wanted to. And in fact, they probably do on a large basis.
Yeah,
right?
Absolutely. And I should have probably put PayPal up here, because my Gen Z and millennial kids all use PayPal and don't even really use a bank account
Venmo
anymore.
is the other one, right?
Right.
All those kids are Venmoing like my son.
Right.
Hey, you bought me a Chipotle. Can you Venmo me the money, pal? That's usually how it goes.
Okay, so I get to put this to you instead of have to deal with it myself.
Ouch.
So I wanted to ask you about Ray Kurzweil and his prediction for singularity. And obviously, banks have tons of data, and they have a hard time using that data. But if his prediction is right, we will come to a point where machines are more capable than we are. What do you think about that with respect to the finance space?
Wow, that's a lot to lay on my shoulders. Like, am I the guy who helps Skynet? Is that that's kind of like the old joke, right? Whenever the singularity. I think just to say what's happening in finance is there's this collusion of events. Just as I talked about with disruption, which is you're sitting on top of lots and lots of data. So what happens when you sit on lots and lots of data is possibilities. We couldn't do them before because the technology and the processing power and the storage of data was not very much available. And what I mean by that is that just think about where we are, and we talked about companies hiding in plain sight and disruption. Amazon started to build cloud in 2006. It has really come to the forefront in the industry for everybody. I don't know how many of you remember, but in circa 1995, if you were a startup, and if you look at any startup and their budget, the biggest item was hardware. That is not a huge line item on any startup's budget anymore, right? Because they're all in the cloud. So take that, marry in the fact that if you look at what happened with AlphaGo, right, which is the other kind of moment in 2013 and continued on, the fact is a machine learned how to play Go and came up with a new way of playing Go that a human being and actually surprised the Go master, tells you you're on that path. So if you marry that and you marry computing power, that's really what that says. Now, whether machines are smarter, my hope for the future in that, I'm sure there could be some very smart machines who do a lot of things better than I do, but I think the real key to that is this pairing of man and machine. And if you look at chess, so there's a great book that Garry Kasparov came out with. He was the first guy to really get defeated by an AI, and he had a soul-searching moment, and he wrote a book about it that just recently came out. But the thing that most people don't talk about with Garry is that he went on to a new level of chess, which is freestyle chess. And if you're not familiar with it, that's where men or women can compete against grandmasters with machines. Everybody gets an ability, and what they found, which I find is incredible, it's not the best chess master who wins these things. It's actually usually mediocre chess players who have pretty good algorithms, and they put a couple of search strategies together, and they dust everybody. So the hope is that technology and the singularity, in my view, comes together with human beings, and we get to a new plane of understanding of what we're doing. So I think that is where finance is headed.
Yeah,
I hope so. Otherwise, I'm going to have to bury myself in the ground and just give up. So.
Well, but it's a long time, right? It's 25 years from now. And my son bought me an Amazon Echo from the US, and we figured out how to get it to work. And I ask it every day, what's the weather? What's on my calendar? It's kind of cool. I would love to be able to say, hey, can you move money from my checking account to my savings account? That would be cool, right? And so that's about data. That's about being able to...
Imagine you waking up in the morning, walking to your kitchen to get a cup of coffee and saying, hey, Alexa, make me money.
Yeah.
Right? And Alexa says, sure thing, Rob. Right?
Now, I put a few things on the right-hand side. Some of them are probably you know, a little out there, but you know, think of blockchain and what's going to happen to Visa, MasterCard, American Express. Do we need them? They take a lot of money, right? They process a lot of transactions, and they play a big role, but is that business model going to survive the future?
So blockchain, so remember I told you about the whole thing when I did my thing about paper and having to transfer to a virtual? Well, it's really funny. So virtual currencies, who's the authority? Right? That's the big thing that comes, and in fact, in the blockchain, Ethereum, and world, that's coming up as like, hey, I know it's great, it's distributed, but like, who actually tells me something is real? And that's where the banks are trying to figure out, because they have a long history in that. So I think you'll see this collusion where there has to be some type of authority, at least, in order to be mainstreamed, and that's usually how markets go. Somebody has to kind of tell you, is like, hey, those guys who gave you stuff, they're for real, even though there's a ledger. You know, but we saw with Ethereum, right? When the first transaction in Ethereum, I think there was a contractual bug that wound up paying somebody out who rigged the system, and they actually went through and paid that out. That's not what you want to have happen. Bugs to pay people out that shouldn't get, you don't want to have happen.
Okay, and I don't know how much time we have. I know I'm supposed to know that, but here's another one. So in wealth management, or when you get a loan or you get a mortgage, somebody makes money when you do that, right? An advisor gets paid a commission, or someone who's handling that transaction for you makes money. Some say that the future is going to be you're going to pay them only for that advice and not a percentage of your loans. So what happens when that industry only makes money on I'll give you $100 to find me the best mortgage?
Wow. I'm just thinking is when they get robots to do that, everybody is going to be kind of happy, except if you were the guy doing that before.
Yeah.
Because like now you can't afford that lake house. Does a robot need a lake house? Right? If he makes all the money for you and he gets the commit, does he get the lake house, or the guy who built the robot get the lake? I don't know.
Yeah.
I've been thinking about that for a while.
We're just going to keep going until we're told.
I think we should probably,
we're
going to ask questions. Is that a good time? There's some mics around. So you're all good Canadians, which means you better have a question. Otherwise, I'm going to be really upset.
Hi there. My name's Philip Bear. I'm the founder of Milo. We're doing a very cool thing where we're charging a technology fee and not charging based off AUM, so that's definitely here now. My question to you was, you said fintech adoption is low in Canada. Is it because of lack of startups? Is it because of lack of awareness, or lack of being conservative?
So I'll answer that, because I know you like to pretend to be a Canadian, but you're not.
I played one on the ice rink for about 35, 40 years, but yeah.
I do think that the biggest challenge in Canada are the two things that I think were on the slide that I talked about. It's regulation, because I think if you want to have a bank license in Canada, it's going to take a long time. There's the OSC Launchpad, which is starting to do some work around how to help startups get to market faster. But I think the other thing is legacy technology. And what people don't talk about, and I worked for a lot of them, are the big tech companies that are the ones that are providing that legacy technology to banks. That's a bowl of spaghetti to have to figure out how to innovate on top of. So I think those are the two things. So there's a lot of banks that are starting to partner with companies like yours, and the benefit is you get access to all their customers, and they don't have to try and figure out how to unravel that bowl of spaghetti.
Thank you.
I have a quick question. So how, as a mobile payment company, can we compete with the Apples and Facebook in Canada? So can it be a partnership with banks or something else?
Yeah, I think not everyone wants to use PayPal. I think it depends on is it your company?
Yeah, like a mobile payment company.
Yeah, mobile payments. I think, so the gentleman, the founder of Milo, asked, are there not enough startups? I actually don't think there are. I think it is really, we're just at the very, very tip of the iceberg over a very long period of time, where startups are going to continue to come up. If Wealthsimple, and I love Wealthsimple and Mike Katchen, and they've gotten a lot of press, but there's 20 other wealth robo-advisors in Canada. So I would say I don't think there's enough. And I think partnering with financial institutions is the fastest way to get scale.
Okay.
Anyone else? Good? No? Uh-oh. You coming up to yell at us or give us one last question? I don't know.
Actually, I do have a question. So, maybe it's a little bit related to what we were just asking, but as we see more startups popping up that tackle decentralizing and non-traditional forms of payment, you alluded to maybe partnering with banks, but what do you see the role of more traditional financial institutions being moving forward?
Whew. Do you want me to?
I want to add something, but yeah, you go.
So, as a guy who has worked most of his life in very large financial institutions, the one thing that really counts against them is themselves, right? So if you think about any big bank, and let's just take it in context, any one of them, you can name them silently yourself, I won't say their names, but the problem is that they are built on a business in which to be successful means they need to look at something else in a new generation, which is tough to do. They can't do the judo, right? So where a bank falls down usually is, we were having this conversation before, it's a typical thing in a bank nowadays to go and hire somebody from a different industry and build an innovation lab. And then they bring them in, and this is, a very usually unorthodox person to shake up the bank. And usually what happens is one of two things. The bank gets religion and realizes, wow, we have to change. And that person is successful. That's a rare instance. Most of the times what happens is the person who does it starts hitting against the wall, and there is no innovation anymore. You can't just buy somebody and say, I'm innovative, right? So that's the key. And that's the problem with big banks today, is they don't know how to do that. They just don't.
I think that just to add to that, I think and this is happening again in the UK, one of the most innovative markets out there, where there's new regulation coming into effect in 2018, that it's the PSD2, Payment Service Directive 2, where banks have to open up APIs to other companies to let their customers get access to other stuff. And so what that's going to do is almost sort of take the bank and turn it into Amazon, right? Because if I can go, and so I think what banks need to think about is how do I keep the relationship and service my customer because they trust me, but stop trying to be the only one to create the product and work with amazing fintech startups and new entrants and offer their products to their clients.
Amazing. Awesome. Let's give it up. Incredible. Thank you so much.